panel today, we're going to go through a bit of a story in terms of the funding options, which is right for different stages of businesses. So we're going to start off from a startup perspective to early stage investing, to growth and to scale, but also finding out a little bit more from each of our entrepreneurs as well. So I'll tell you what, I'm going to start with you, Stuart. So off you go. Tell us 30 seconds, no more.
Perfect. Hi, everybody. I'm Stuart Brown. I'm a partner of Angel Groups, which is a national network of angel investors. I've been involved with startups for about 18 years, spent the last 15 years working with VCs and early stage investors, and the last 4 or 5 specifically working with angels, early stage investors, facilitating investment into startups totaling about 12, 13 million, all via angels, high net worth groups and syndicates.
Thank you.
Hi, I'm Steve Ward from Business Enterprise Fund. We are a social enterprise and we lend money to support businesses, and we run the Startup Loan Programme in Yorkshire and the North East. We run the Northern Powerhouse Investment Fund, and we've got our own funds as well that we use to support businesses. But the big difference is we're not doing it to put money in the hands of shareholders. We're about transforming communities by encouraging people to start businesses.
Wonderful, thank you.
Hi, I'm Jam. I run Draper's England, which is a luxury spirit brand distilled in the heart of Yorkshire, and it was born out of a 1920s speakeasy in Leeds city centre, which is a tailor's by day and an all-singing, all-dancing 1920s jazz bar by night.
Hi, I'm Gordon Bateman. For the last 34 years, I've been working with Risk Capital about designing and building the probably the most toughest part of growing a business, which is the people side of the business. And then 10 years ago, created a thing called Invest Ladder, which was around bringing that money into the region and developing the regional ecosystems by bringing money from outside in.
Thank you.
Hi, my name is Victoria, and 3 years ago, I set up Bindethics, which is a biotech company that is developing bioadhesives for engineered wood products.
Thanks, Victoria. And I'm Jordan Darg. I'm the co-founder of Lifted Ventures. I've been working in the venture capital landscape now for over 13 years. To date, I've successfully supported organisations to deploy over £450 million worth of early stage investment. And Lifted Ventures now exists to help increase the flow of capital into female founders. So I'm going to start off right at the beginning of the journey for organisations when you're looking at that first round of investment, typically known as startup funding, okay? So Stephen, I'm going to come to you first if you don't mind. And can you tell us a little bit about what startup funding generally looks like, really focusing on the debt perspective?
Yeah, so people often look at debt as a bad thing and kind of want to err towards the equity side of things, Dragon's Den, all that kind of stuff. The thing about debt is it's very flexible, it's very easy, generally speaking, and it's a very easy entry into the market in terms of trying to get your business started. And it's particularly easy when you come to Business Enterprise Fund, because we've spent the last 20 years working with early stage businesses, running the Startup Loan Programme and getting that kind of capital into small businesses. In fact, we've just hit the £100 million mark in the Yorkshire and Humber region for startup loans. So,
Brilliant.
you know, and when you're doing an average loan of about 10 grand, you realize how many businesses that is. So we're experts at supporting small businesses. So just to get you on the ladder, it's the right thing to do. So it's really important that you've got flexible finance, people who understand your business, people like ourselves who are prepared to work with you and support you through your journey, and more importantly, through the business cycle, which is never flat, surprisingly. Yeah. So yeah, startup loans.
Yeah. Brilliant. Stephen, just a quick question on that as well. In terms of actually being able to receive a startup loan, it's not a startup loan per organisation, it's a startup loan per co-founder. Is that correct?
Well, if we're just talking about startup loans, that's correct. So technically, you can have up to 4 startup loans, up to a maximum of £25,000 per business. So that's 100 grand. But don't get excited, because we're not going to let you have that much. Just saying that, okay? Because everybody always comes to us and say, can we have the maximum? And we manage to get them down to a realistic figure. You can always come back and have another bite of the cherry, and we'll give you the Brucey bonus at the end. But first of all, it's about responsible lending and ensuring that we support you in the right way and not get you too giddy in the early days. Because people do get giddy when they start businesses.
I can imagine, absolutely.
Yeah.
And actually, £100,000 for a startup organisation is an awful lot of money. So you can imagine why they're pushing for the top end. What would you naturally be looking for in terms of what a startup would need to present to you to apply?
Yeah, okay. So, as I say, the key to us is responsible lending and ensuring that we support you in the right way. So, first of all, you've got to have a decent idea. It doesn't have to be original. It doesn't have to be unique. It just has to be a well thought through idea. And you've got to be able to demonstrate a market, that you're able to get revenue fairly quickly, and that you've got the determination and the stamina to get going. The thing about being a startup business is if you can survive the first year, I've got a principle: survive and then thrive. If you can get to those two stages, you're doing okay. The first year is generally about surviving, and we just need to help you understand how you can survive in your first year.
Yeah.
There's another one, but I can't remember it. So sorry. So we'll just go with the two.
Just go with the two, absolutely.
I'm having a mental block.
I guess, typically myself working with early stage organizations, it's often really beneficial when we get to meet an organization that has taken on the startup loan. Number one, it's giving the investors, so angel investors is who I work with, an insight into you having skin in the game. So what we mean by that is you've been prepared to take on some very early stage debt funding. But number two, it also gives us an opportunity to see how you've spent that money as well, which again gives us real confidence when we're starting to assess a business taking that first step into angel investment. So Stuart, coming on to you next and talking about angel investing. Again, starting off with the same question, what would you typically look for? What does a business need to present, and what's the key standout points for an angel investor when they're looking at let's call this an early stage deal? So not a startup, but an early stage.
I think one of the key things is, and look, this will probably resonate with any or many entrepreneurs in the room, you will get loads of conflicting advice. And everyone always has their own opinion as to what you should be doing, how you should be shaping. So it's really difficult. And your job is really difficult in being able to, I guess, sift through all of that information and work out what is relevant. But if I kind of boil down to angel investors and looking then at early stage businesses, and I often say keep it simple. And angel investors are then used to and familiar in investing in early stage businesses. And from having interaction with many, many hundreds, if not thousands of businesses, I think some of the real key standout points is keep it really simple.
Yeah.
And I think far too many times I see, and this is again feedback from many, many angel investors, is what is the business actually doing? And there's this beautifully crafted pitch and lots of information about the positioning, but actually it misses the one key thing. What is the problem that the business is solving? 2, who are you solving that for? 3, how are you solving it? And 4, or kind of 3B, is kind of how are we doing that different, and what is that differentiator in the market?
Yeah.
And I think if you're able to get across those key points, then that will resonate with the biggest audience possible.
Yeah.
I kind of add to that. And if you can do all of that in a way that one of your elderly relatives would understand it, then you've got universal appeal.
Yeah, absolutely. And how big a market opportunity there is. So that's value proposition and how big a market opportunity there is. Now, for angel investors, Stuart, we both know that there's a real big incentive for angel investors to be investing. I'm an angel investor myself. I don't just invest because it's the right thing to do. I absolutely do love supporting founders, but I also invest because there is tax efficient investment schemes. Stuart, final question for you. Tell the audience a little bit about the tax-efficient investment schemes. And if you are looking to raise equity-based angel investment at this stage, why you should be taking this into consideration now?
Yes, well, as Jordan very rightly mentions, I mean, the UK is absolutely unique in the mechanisms that are in place in terms of SEIS and EIS, kind of the tax advantage schemes. For rough context, and forgive me, these are numbers kind of off the top of my head, but I think 22-23, from an EIS perspective, there was 1.9 billion of investment raised under the EIS schemes for new and existing businesses. I think just shy of 500 million of that was brand new businesses raising via EIS. A subset of that, which is SEIS, for brand new businesses been trading less than 3 years, able to raise up to 250,000. That even sits at 140, 150 million. So these are big sums of money. There's a lot of capital out there. There's a lot of angel investors out there. Finding them is very, very difficult. It's a really, really fragmented landscape, but the capital genuinely is there. And as I say, the UK is unique in providing those schemes, which sets us apart from the rest of Europe, the rest of the world.
Yeah. And I think as well as Stuart, I can probably go a little bit further on those stats as well, because that's UK-wide, isn't it? And 22-23, it was reported that only 4% of that sum actually was deployed into the Yorkshire and North East regions. So that's a very small amount. So it goes to show we need to be pushing that more. And we also need to be ensuring that we're getting more angel investors backing our startups and early stage organizations. But we also need to be educating our founders on why that is really, really super important. So thank you, Stuart, for that. Victoria, I'm going to come on to yourself next, okay? You've literally just raised your pre-seed to seed round of funding, which you spoke about. And obviously, I'm so excited for you because we helped you. But one of the big things for me is blended finance, okay? So Victoria, you mentioned in your presentation already that you were able to successfully raise grant funding. And also successfully raise angel investment funding as well. Tell us a little bit about that journey. Obviously, we've already heard about the journey on the grant side. It wasn't easy, but you were successful. But how was the journey for you taking on that approach to actually completing that grant funding? But then how did that help you leverage your angel investors?
Perfect. So that's, as I said before, when I started the business, I didn't have anything. So it was through grant. So it's public funding that it is there and it is available. When I started applying for grants, I didn't know how to write them, but then you get feedback and then you learn how to do it. So grants and making use of the support from Adventure, from RTC North, what FSB, like all of like that regional support that we had access to. That's how I started. Also, in my case, it was through awards. So then you apply for awards. Sometimes they have like a cash prize, and then you build it. So once I had that, it's just a matter of applying for bigger grants that in this case required match funding, and then I had to also become an expert on how to pitch to investors.
Brilliant. And the reason as well, obviously, grant funding is really, really powerful in terms of being able to receive angel investment. Essentially, if you've got grant funding in your organization and you needing to leverage angel investors, it really does de-risk the investment for the angels or the early stage funder if you've also got grant funding in there. Okay. Grant funding, it's non-dilutive. It doesn't dilute the shares for the founder, okay? So basically, it is government public spend that's going into that organisation, which you've got some strict reporting requirements against, absolutely. But it means that there's more investment going into a business without the shareholding coming down, and there's certainly no repayments of that grant if you stick to the terms and conditions, obviously. So Victoria, obviously, aside from actually doing the fundraise, what was, I guess, some of the challenges for you going through that process? And what would be your ultimate recommendation in terms of perhaps some other founders that are in the room, and particularly female founders that are in the room? What were some of the challenges, and how did you overcome some of those?
Okay, well, the first thing is that with grants, it's not like it's non-dilutive, it's true, but it's not all bubbles and pink, because you have reporting to do. And the piece, unless you find a really very good grant, which they're not somehow doing anymore, you have to have the money first, so that you spend the money and then the government gives it back. So that's something you need to be prepared for. So then I'd say that is the first challenge in the whole entrepreneurial journey when it comes to funding. And yeah, you mentioned it. Unfortunately, it is not a myth. I thought women complain, but it can't be that difficult for women. But it is not a myth. It is the way it is. So thank you, Jordan, because Lifted Ventures is well, you and your team really doing something about it, because it's a real challenge, and it is not a myth as I used to think.
Yeah, absolutely. And it's not getting any easier either, is it? So yeah, and well done again, Victoria. Gordon, coming on to yourself next, if you don't mind. So we're going to step into the realms of growth and scale with Gordon. So your business has gone through a startup phase, had some startup funding. It's gone through your early stage, had some angel investment alongside some grant funding. We're now going to enter into that next phase of growth, potentially that seed round, working towards that Series A. Gordon, differentiate for us, for the audience, what's the difference between growth and scale?
Can I check that a different way? Put your hand up if you think you could honestly answer that question, that the difference between the word growth and scale of your business, because they're two words we've heard a lot today. Do people in the room know what the difference is between growth and scale?
One or two.
That's one of the biggest challenges I've seen. I even had to Google it. I've been in the room in this industry for 30 odd years. I think one of the challenges is language. We bang on about SEIS and because we're in this world. And I think one of the challenges in growing and scaling a business from an investment perspective is knowing the words of number of conversations that I've stopped to say to people, do you understand what he or she has just said? I did this at a dinner the other night and everyone on my table just went, no. So the difference between growth and scale, allegedly, according to Google and Wikipedia, is growing your business is growing revenue at any cost. Scaling your business is around your profit and your margin. So it's growing your business whilst increasing the margin of your business. I thought scaling, having scaled a business to an IPO, was just growing really fast. But apparently that's what it is.
You're absolutely right, Gordon. Well done, Google. Okay, so Gordon, taking on the approach, obviously, let's start with growth phase. Okay, so growing the revenue in the business, not potentially actually reach profit making at that stage, so growth stage. What are the funding types that you would be considering for your organisation?
I think it's a really good question. It made me think on a Tuesday morning, I guess, really. So I think there's no one size fits all. A few people, and I'm conscious that Bolu's out here with a whistle and I talk a lot, so I'll try to keep this short. But I think, as people have explained, there's no one size fits all. And I think having options and looking at all those options is really critical. In 34 years of doing this, I think it's the toughest market I've ever seen for raising later stage finance, whether that be debt or equity or whatever it may be. The money is out there, but it is more competitive. There's a lot of businesses have gained seed and pre-seed money over the last couple of years. We're now fighting for that later stage money. The later stage investors, the venture capital companies, early stage private equity companies are being more cautious. The UK market is really tough right now. So I think the key is looking at all the options that are available to you. And it's not always on your doorstep. It is going further afield, and that's not just further afield in the UK, that's further afield internationally. But we've talked about grants, we've talked about debt and equity, but equity isn't for everybody. Yeah. A good friend of mine in the US, she kind of investment royalty, I guess, really in Silicon Valley, and so talks that only 1% of companies in the US raise venture capital funding. So having that thought, is it right for your business, is key.
Yeah, absolutely. I think you made some really good points there, Gordon. It is a really difficult industry in terms of looking at how you deploy capital into your business. absolutely would 100% recommend that you speak to as many investors as possible. You speak to venture capitalists because they're all looking for something quite different as well. So, Gordon, you touched on, I'm going to move to Jam next, but Gordon touched on there that actually raising capital is not right for everybody. So we're going to ask Jam to focus on actually how she grew her business without taking on investment and looking at how she organically grew that business as well.
Well, I think we, as a family-owned independent business, we have been very proud for the best part of 6 years that we have put in the hard graft, hard work, and gone from doing pretty much every job there is, from sweeping the floor to, producing the products, designing a lot of the branding, looking at ways we can reduce costs so that we can also grow at the same time, reinvesting a lot of the money into the business. But all of the while, we're constantly kind of looking at how we can reinvest into that business, showcase the growth, and continue to grow at a good level. And it's not easy. I think actually it was at Climb just this year where I think the penny dropped, and I thought, God, we've spent so long doing all the hard graft. Why haven't we looked for investment sooner? Because actually we're probably ready to do this maybe a year ago, if not slightly before. So yeah, I suppose it's a bit of a two-sided coin.
But I also think as well, Jam, you've explored all areas of your business in terms of how you grow and develop that. Now, if you were looking to now come out and raise investment, you would be looking at VC funding, and you've got all the shareholding in your business.
Yeah.
You've probably not got much debt behind the business.
No,
you're in a really, really positive position doing it that way, which will make you ultimately a really good opportunity for investors to be considering.